what was exciting in the last 2 years was two of the longest bear markets were terminated. And that was Nikkei and that was silver. I do not believe in cycles, but I believe in asset price regime shift when the atom escapes the ceiling which has been there for 10, 15, 20, 25. When it breaks, the universe is changing. Profound price regime shift in dollar yen, which has a knock-on in the Nikkei, and is probably related to what happened in the silver market and the gold market. The Nikkei is going to go up 5 times. The yen is at a 50-year low versus the dollar. The biggest currency crash in 50 years. No one's talking about it. We're going to 200 on dollar yen, but really the action is in the silver. Silver goes to 200. Why? I don't know. Why do people ask that damn question? If the 10-year Chinese yield consistently trades above 2, Chinese equities are going to the moon.
Welcome to the Microscopic Podcast presented by Gold Republic. My name is Alexey Joranov, and in this format I invite you to look at the world through different lenses to see what's hidden in plain sight. Well, welcome back to the Microscopic Podcast. Today I have my friend Hugh Hendry, Hugh the asset capitalist, straight from St. Bart's. Today I hope that we'll be able to unpack some wisdom, some epiphanies that you've might have come across in the last months, reflecting on also 2025, on the things that we've also discussed in our past interview. I think it was almost 8 months ago. First of all, I would like to know from you, how would you, let's say, if you look back at 2025, go through the lens of your own framework? What did you generally get right, and what surprised you enough that you'll say you got it wrong?
I think we were talking just before starting that I always think at the beginning of these videos, I ain't gonna make it. I got nothing. And I definitely feel that way. And prognostications, January forecast, I hate that shit. I mean, this is maybe one of the last YouTube videos I do. I'm done with finance people. I'm like, I don't know if you've seen my Twitters. You were saying epiphanies. It's more like profanities. I've discovered a new edgier voice, which is vulgar. But to your question, the standout surprise, disappointment, if you will, through my lens, would of course have been the sell-off in Bitcoin, and the disassociation with the rest of the alternative asset universe, and of course especially the PGMs, with gold, that whole universe where gold is the sun, and silver and platinum and palladium and everything else rotating around the centrality of gold. So Bitcoin selling off in the fourth quarter was a head scratcher, if you will. Does it change anything? No. But that would have been it. That really would have been the only thing. I mean, everything else pretty much what you expect. Stocks have got a bid, tech's got a bid, tech's got a story, and it's got an earnings momentum, and it's got fear. You're climbing the proverbial bullshit wall of worry. So it had bubble dynamics. So when we were back in that sell-off from March into April, which was steep. I think we almost got to 20% on the Nasdaq. the big question I was asking myself back then was, is it kind of March 1998 or March 2000 with regard to going back to the entrails of what was described as another tech bubble market. March 1998, stocks were highly valued, tech stocks. March 1999 stocks were very, very highly valued. I mean, do you still interview people who quote price earnings ratios and say, oh, you shouldn't be in stocks because they're overvalued? I mean, I think most of those people have been left behind. It just, from a market timing perspective, the whole valuation metric just doesn't work. Anyway, here we are in the new year, and I think conclusively we know that it was certainly not March 2000, and it was more like March 19. I keep saying me, I'm 1998, and so we've probably got another 2 years of equities being aggressively bid for. Yeah, everything else pretty much what I would have thought. The sell-off in Nasdaq in Bitcoin, unexpected. Its lack of willingness to participate in the explosive trend appreciation in the silvers of this world. Odd. Is it a cause for worry? I mean, I'm not worried about it. Yeah, I still think Bitcoin will trade at $1 million, but we might flesh that out again later.
You've also argued, because it's inflation was also one of the core theses that you've been also laying out, that it should actually go way down. You've argued that inflation failed not because of central bank virtue, but also because the sheer size of the Treasury market acting as a sort of fire break. Walk us through that mechanism.
See that last? Forgive me. I was on a boat yesterday. I was in the sea, and I've still got the Caribbean Sea in my ears. So the inflation and the inflation last year, I think, defied the pessimists. But what was your final observation about the inflation?
Yes, because you were saying that the sheer size of the Treasury market acts as a fire break. And I wanted you to walk us through like the mechanism of how that would function.
Okay. So first and foremost, we've dropped from over 9% annual price inflation to, let's call it 3, but kind of the underbelly of 3. So there seems to be a mechanism, if you will. For 50 years since the dollar came off its peg with gold, all your community have been shouting, inflation, hyperinflation, Weimar, inflation, fiat currencies are fraud, etc. Okay. And in 50 years, we had one tumultuous 8-year period in the 1970s, where we had a lot of inflation. But by and large, 80% of the last 50 years could be described as a disinflationary environment. The 9% inflation of 2022-23 dissipated because Federal Reserve had the sharpest and largest incremental rate hike from 0 to 5.5%. And the long end of the bond curve moved in lockstep, and everything parallel shifted higher. And the debt, the government debt, is 1 times GDP. So in terms of, it's a significant stock, not something you can ignore. It's 1 times GDP repriced at 5.5%. And then, of course, add at a small business premium, and businesses looking for working capital financing and looking for real estate investing, etc., were confronted with a profound tightening in policy. And at the same time, there was not well, at the same time, but very much as a function of that, the appetite to borrow was not excessive. So again, one of the classic amateur investing things is to quote M2. I hope you don't do that. It's meaningless. M2 surged during the COVID pandemic. Why am I urging you to ignore it? Because M2 is a measure of deposits. When all the inflation juice and action and determination is loans. Now, if you're on the sharp side, you'd say, hey, listen, in a bank balance sheet, deposits are matched typically with loans. So if deposits have gone up, the expectation would be, so the whole premise of M2 is the deposit figure can be determined, can be calculated, and under normal circumstances, whatever normal is, but maybe using 150, 200 years of kind of banking history. Profit optimization means that banks seek to lend out their deposits. The deposit's a liability. You have to pay a rate of return on that, and so you seek to have a commensurate or higher return from your loan book. So the loans, however, we didn't get the inflation because if you go, the ratio of loans to deposits fell. And partly that was a function of the cost of carry being greater than small businesses could sustain. And also on the personal sector, there's been no turnover in the housing stock. There was a profound, I mean, we throw these words around profound, but there was a profound movement between 2021 and 2022 when the entire US personal sector fixed its mortgage rate, and it went 30-year long at like somewhere probably about 2.5–3%. And so there are no housing transactions, because if you were to buy a new property, you would need a new mortgage and you'd reset from 2.5% to 6.5%. So for all those reasons, the system did not, the Treasury market was a profound handbrake. And there was, which prevented the monetary lubrication, which comes from loans, from taking off. And so in its absence, prices have decelerated. And, the Treasury market, long end of the Treasury market was dull, but it was positive. I think Treasuries were up about 5 or 6% in dollar terms. And, and the long end of the US Treasury market remains intriguing for the simple fact that there's kind of like four, I'm going to say cardinal, and I'm referencing like compass and coordinates, that there are four cardinal points in the world of macro. And one of them is the S&P, and one of them is, if you will, the 10-year Treasury. One of them is the US dollar. And the other one, we could say gold, but you take something from the alternative asset universe. That could be gold. It could be prime real estate. There could be private equity returns. It could be Bitcoin. It could be silver. But let's use gold. And so in those four cardinal points which determine the economic and the financial weather for the entire planet Earth, they observe and their price movements are governed by mean reversion. And so the fact that the long end of the US Treasury market has had a 50% drawdown is intriguing, because at some point mean reversion will take it back to parity. That drawdown will disappear. I don't know when, but clearly the drawdown has stopped widening in terms of the last. I mean, we're still, I guess, in the opening section where we're kind of looking a little bit behind us. So again, a review of 25, inflation moderated. We started this time last year. There were many fools, typically suits, gray hair, boring, believing in M2, believing in, I don't know. And they would have told you inflation, inflation, inflation. That has not been a good call, and the bond market has, for 1 year at least, it stopped falling, and it at a 50% drawdown. It has to be kept in the camp of being interesting. We're looking for an opportunity to buy it when it finds some momentum. I guess the other thing, and you probably would ask me it next, the provocative and prominent risk price move from last year would have been the decline in the dollar. And that would get, again, a lot of your kind of gold hard asset crowd. Oh, I told you fiat is rubbish. Yeah, you know. The dollar as a currency has been a very robust store of fiat value. The decline last year. So I hate finance. That's why my tweets are now like using the words bastards, wankers, come stain, fuck off, etc.
What do you hate it? What switched now? Like what is or maybe switched not, I don't know, but researched maybe.
I don't hate the pursuit of knowledge and the trying to glimpse desperately into the future. You know, the whole asset capitalist movement is trying to lead a rebellion, and to say that all of that is a creative force. That the more you try to be rigorous, the more you left brain it, the more you sit staring at spreadsheets, the more time you spend thinking your shoes should be polished, that your suit should be more expensive. You're further and further away from seeing the future. And you're just repeating mantras like M2, like liquidity. I'm going to talk about liquidity in the context of the dollar. And so it's just it's the circus of kind of left-hand side parts of brains telling you what to do on YouTube and Twitter. And remember, the left-hand side is the utility function of the left-hand side is rapidly approaching zero, because now we can hook on AI onto the left-hand side. So the thing that AI is okay, but the thing that's really far away from is creativity. So let's be creative. The dollar was weak last year because stocks were strong. And lifting the scar tissue of that, the currency movements, from my mind, are determined by what's happening in the euro dollar system, which is to say the creation of new dollar bills created outside the dominion, outside the sovereignty of the United States, so offshore. We say euro, but probably Japan is the largest actual printing source.
Sorry to interrupt you, but when you say strong, what do you mean strong relative to what? Because the Dixie did lose 10% over a year. What exactly do you mean?
Okay, what did the Dixie do over 5 years and over 10 years? What has the Dixie done since it devalued versus gold?
Well,
was
5 years was 9%, and 10 years was pretty much the same.
Pretty much the same. It just goes sideways. It's been sideways for 50 years. Right. And again, what's tiring is it goes sideways, and as soon as it moves a little bit in favor of someone's dumb prejudice, they go, oh. And so that's why I'm just exhausted. But anyway, um, the and relative, I said to you very carefully in my language, the dollar has been very good at holding its fiat value. And that's all you need it to do. You have so many ways of protecting your wealth. I don't know why. I honestly, I don't know why thousands of pages and thousands of hours are dictated by this notion of being this fear of fiat. You've got your money in stocks. You can buy gold. You can buy PGMs. You can buy Bitcoin. You can buy real estate. You can buy private equity. I've got 7 or 8 million euros in debt fixed at 2%, and I've still got another 17 years. Like, why do we fear some notion of fiat collapse when we're all protected from it? So it's just like, why are we talking about it? And I think we're talking about it because it shows an innate misunderstanding of money. There's only like I say, provocatively, it feels like there are only 5 people in the world who actually understand money. So in talking about money now is created. Money's always been created under with the context of collateral. You got no collateral, you ain't going to be creating money. If you got collateral, you're going to be creating money, printing money, printing money. So the dollar typically weakens when animal spirits with the banks and the private sector, but it's the banks and the counterparties. It's how they feel about the world, and how they feel about the world is determined by asset price changes. And so when the S&P is up 15%, they feel good about the world. And so when you call up and you're looking for a line of credit, they're like, yeah, no problem. And the line of credit is the first step in a chain which produces a new US dollar. So for my mind, it's no surprise that when stocks are in a bull stroke bubble, dollar's going to be weak because of the printing mechanism and therefore the lack of scarcity which the dollar exchange rate has to pick up. You saw that in 2008. Dollar was very, very weak until it was very strong. And someone actually, so we're all fearful of inflation and this notion of the fiat collapse. Okay, I'm saying to you, we're all protected for it because we're invested in real assets. But in being long real assets, and I mean every asset from Bitcoin to an index-linked Treasury, tip, from all of them, you're short volatility. So the one thing that your audience, the one thing they're missing, I would say, for completeness of security, would be dollars. That they should probably denominate their assets in dollars. The dollar, and if I take it back to what I was saying, the dollar is implicitly long volatility. You're long volatility, and that diversifies your short volatility book, and that has to make some sense. And when I say the dollar is long volatility, what did I just say to you? I said that when stocks go up, the dollar goes down. That's what volatility does. And of course, I referenced 2008. But of course, when stocks really started to tank, the dollar exploded higher. It went from like 77 to 150. That'd be a nice cushion on your risk portfolio. And actually, and then if you were trying to, like, so if I was trying to be really, if I was given a mandate, and is the credit agreement, and I was given like $100 million to protect for a billionaire family office, I would denominate in dollars. Obviously, there'd have to be some consideration about the nationality of the family office. But let's imagine they're a European family office. And then I would also, and this is not meant to be provocative, it's certainly not clever, but I would be buying one touch, but I'd be buying variance. I'd be buying long dated options, speculating that the peg in the Saudi Riyadh and the Hong Kong dollar go. The world is evidently changing. Last 50 years, the next 50 years kind of going to look, I think, very different from the last. The Saudi peg, will it make sense in the future? Like, look at the oil price. Where's oil going? I mean, oil looks as if it's definitely going to $40, but maybe it's going less and less. In the future, we'll talk about AI and stuff, but in the advances with solar, with the amount of energy we can take off the sun that we're not utilizing just now, with batteries, battery technology, where's oil going? It was a head scratcher initially for me summer last year with the data center and this huge new demand on the grid. You'd think that would kind of make oil scarce, but oil's got competition. So if I could get no, obviously you can't get a 50-year, but you get a 10-year structured option, which today would cost you nothing. If you phone a broker, and they're like, you're a joker. And yet, first of all, can I say, hand on heart, I am a joker. I am a provocateur. I am not here to be the serious guy in the room. The serious guy, problem with the serious guys, he makes and he loses money at the same time as all the other serious guys. I'm the joker. And I've had those conversations. I bought Nikkei 40,000 one touches at 3 a.m. in London, changing a nappy actually, but multitasking. And the guy's like, "What?" He's like, "Yeah, blah 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 blah." Now, in my valuation of the hedge fund the day after, that was marked to zero. I spent $250,000, and we marked it down to zero. So it's that kind of, and so I probably spent every now and again I'd come in and I'd spend 2-3 basis points, hundreds of percentage points of the NAV, but I'd keep doing it. But my point is, there's no premium. If you want to buy a put option, the stock market is going to crash. It's going to cost you. Yeah, it's going to cost. If you want to buy a call option, Nvidia is going to go up 20% this year. It's going to cost you. It's like an LVMH bag. It costs way more than it should, logically. But if you go in and you're trying to buy, the dollar peg ending, they'll just write you the ticket. Yeah, whatever. Go away. Go away. Go away. Go away. And there, what you're doing is, you're buying your convex long volatility. And so if I was looking after a family office, I'd be doing that. So I'd have my Bitcoin just now. The tech is moving, and I think I've got a strategy on that. Gold obviously has been in the ascendancy. I don't think gold returns are convex anymore. I don't think you're going to double or triple your money. Pretty certain you're not in terms of the next 5 years. But could it go 6,000? Yeah, I would own gold. Wouldn't be my biggest, but I'd be owning the satellites. So again, gold is it's in the ascendancy, has all this power, but its mass is so great. It's a 35 trillion dollar asset market value. And that's why I don't think it can be 150 trillion. And I'm kind of in it to make 4 or 5 times my money. But I'll travel a little bit with it. But really the action is in the silver. Silver goes to 200. Why? I don't know. Why do people ask that damn question? Why is the least significant, the least important, the worst question you can have? And do you know why it's the worst? Because it will stop you taking the risk on. All I know is observation. I look at the nightly sky. I see shooting stars. And the equivalent of shooting stars on Earth, heaven on Earth, is when a risk asset has had a price limitation, a cap, a ceiling for a profoundly long time. The Dow Jones, when it peaked in 1929, it was capped for 25 years. The Nikkei in Japan was capped for over 40 years. And silver, I think, what was it, 45, 46 years? When you take the 50 out, you go 4 or 5 times higher, 200. So I'd be happy with all that. You're going awful silent. You're like, have you
No,
been
no,
at the
I just
coffee
thought,
shop? Have you been to the coffee shop?
no, not at all. Actually, I'm doing detox this month. No sugar, no carbs, no gluten, no nothing.
This
So
month, it
all
should
good
be
here.
every month.
Well, I'm doing it for 40 days. Let's see how it goes. But I agree
Okay.
with you. Feeling great. So yeah, the question to silver, you seem to be either surprised or you don't understand why it shoot up now. Like what's the surprise in there? Like why don't you believe that this move is deserved and what silver did in the past year?
Because you use lots of provocative adjectives there. I don't understand. I'm confused. Um, and you're really missing the essence of what I'm saying. I'm saying that um, a lot of people tuning into this, if they're still here, wow, incredible, thank you. But if they're still here, it's not their number one occupation. It was my number one occupation. Um, and so if we were to separate those who are hobbyists from those who live or die with it, understanding gets in the way. Like once you've accumulated, unfortunately, I've accumulated 30 years of doing this shit. As damn hard as I try to be an idiot, I'm not, I guess. But understanding gets in the way. If you understand this market, apparently its price earnings ratio it's been too high for the last 40%. Gets in the way. Uh, the only thing I care about silver is that for the first time in almost 50 years, it traded above $50. And it happens to be called silver. Could be called anything. When I say could be called anything, let me caveat that. Depending on whether there's so the problem being in other commodities is that you get is the shape of the forward curve, contango, backwardation. Uh, Natural gas has such a negative cost of carry, for instance, that anyway, I'm diving into the tall grass. All you need. So what was exciting the last 2 years was two of the longest bear markets were terminated. And that was Nikkei and that was silver. To give you another history lesson, NASDAQ regained its 2000 price high in 2017, and it trades 5 times higher. And we could go through a lot of these things. Like just now, I don't know if I can see it on my charts. Intel, I haven't looked at a chart this year. This is the first time we look at a chart. And I'm sure you'll bring it up and it'll be very professional as I talk to it. But Intel is pretty close to making a 25-year high. I'm looking at Intel just now, it's $50. And the high, which of course was kind of 1999. So 27 years was 76. So they're about $26 away from Intel making a high. I'd buy it. I'd actually buy Intel just now. Nokia is another one I've been discussing. Nokia's, heavens, where is Nokia? Nokia's about $15. Put that one in. I don't even think it's $15 actually. Hold on. Nokia, the ADR. Did I say $15? I'm dreaming. $6.50. And its high was $60. Yeah. So this is very zero value added comment, but I could imagine a world where Nokia trades higher than it did in the year 2000. And if it does that, I could imagine Nokia rising from $60 to $300. So it's $6.50 now, and I can imagine a world where it could trade at $300. Like I said, but that's how my mind works.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at Gold Republic. At Gold Republic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, securely saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at Gold Republic, we offer real assets to safeguard your generational wealth.
We also spoke a lot about Japan last time. And since we spoke last, I think the 30-year JGB surged from 3% to almost 5%, 4.9, reaching a 30-year high, and violently spiked by almost 50 basis points just within a week. So what does Japan tell us about the future?
I don't trust those stats you were using on the 30-year. I have to see that. Hold on, I have to see that with my very own eyes. I mean, I know the yield change. Market square. On my chart.
Sorry, it's 3.8. I didn't. 3.8. Sorry.
I thought you were a percentage point too high.
No, that was my mistake.
Yeah,
but still,
even for someone who's not looking at these things every day, I knew it was wrong. And that's really one of the important things. You don't need to know a huge amount. You just need to know a little. In fact, the more you try and know too much, kind of paradoxically, the less you're actually going to know. It takes a lot of confidence. It's one of the, I was saying to you that, people are looking for tips on shows like this, and you come to the wrong place. I ain't your private dancer. I ain't your private stockbroker. I don't give tips. But I'm an intriguing, interesting, successful person, and I reveal how my mind thinks. And there are times when it flashes and I see opportunity. I'm talking as I try and log into my interest rate chart book, taking on the same move as the U.S. Treasury. 2020, we were they were zero. U.S. Treasury 10-year, the 30-year. The 30-year got to about 90 basis points. I'm fed up looking at this chart. Now I've got to find you. Where are you? Which browser did we put you on? Are you on Chrome?
I'm over here.
I can hear your voice.
I'm kidding.
There you are. I found you. Oh, Japan. You should have introduced Japan not with the 30-year. You should have introduced it with the dollar yen. The dollar yen at 160. So dollar yen's at 160. The yen is at a 50-year low versus the dollar. Is arguably the biggest currency crash in 50 years. No one's talking about it. Don't you find that amazing? Like, do people still remember the Tiger crisis? Do they remember that the Thai baht collapsed? Do they remember that in just before LTCM? And again, back then, another relevant data point would be the Russians chose to default on their ruble debt. People default on their dollar debt. Very unprecedented to default on your fiat debt. They did it. But do people remember currency devalue? Like sterling got kicked out of the ERM. And all of them happened in the last 50 years. What's happened in dollar yen is the worst currency deval of them all in 50 years. And no one cares. I mean, someone cares. Back to your point about the 30-year yield. And again, back to my point with the only thing that really intrigues me is kind of knowing when to play. I don't play with everyone else. And my thing is asset regimes which change, asset pricing regimes which change. So when there's been a price ceiling of 10 years, 15 years, 20 years, the longer the better. I want to buy new pricing regimes. And I don't want to sit down and explain why. I'm just like, that's what I do. It's very explosive. When the universe contains an atom, and it contains it, and it contains it, and then the atom escapes, it goes up 5 times. Just how the universe works. Japan has done that. The Nikkei is going to go up 5 times. It's already gone up. It's already doubled. But it'll continue to double. That's where we are with the Nikkei. Okay, so why? I'm going to answer why with a comparison subject to the same COVID pandemic, fiscal expansion, and economic concerns. Blew up the fiscal balance sheet. Inflation ran at 9. And for a brief moment, for the private sector, wages turned positive real. In Japan, they continued to blow up the balance sheet. Inflation surged to, I think, 3.7. And wages have never turned real. So that's different. Japan has been engaged in a program since 1990 to achieve consistent domestic price increases greater than 2%. And it's failed. They began to realize that one of the reasons for failure was a kind of Pavlovian dog response from credit markets. So back to my point, the very beginning, your question was the Treasury market is the tail that commands the dog, that its presence, the fact that it's 1 times GDP in America, is quoted as 2.7 gross in Japan, but with the overseas assets, it's like 1.5, 1.6 times GDP. Japan's ambition to generate inflation has been prevented by the size of the Treasury market and the yield going up, and so the private sector tightening monetary policy. The theory is that they've been conducting yield curve control and they've been buying JGBs to stop that. So they've had to use a sum of trillions to kind of contain the yield to stop monetary policy tightening and preventing their objective, which is inflation. And they ran that yield curve control for about 2 decades. It proved impossible. What I like about the Japanese actually is, I think it took maybe 9 or 12 months where they kind of changed the intervention targets for yield curve management. And the market kept pushing through it. And rather than fighting, because when a central bank fights like the Bank of England did back in the day with Soros and Scott Bessent and Stan Druckenmiller, you're creating entropy. You're actually making it very fragile, and boom. Japan actually was pretty wise, like, yeah, we don't need yield curve control anymore. They saw the limitations, but their number one objective is inflation, and it's positive wage price increases. So the only way they can get there is via the currency devaluing. And so again, 50-year chart, price regime is changing. We are living in very exciting times. Profound price regime shift in dollar yen, which has a knock-on in the Nikkei, and is probably related to what happened in the silver market and the gold market. And they're all knock-ins. The amazing thing, again, is Japan is devaluing, and typically the US would like, what the fuck are you doing? Stop cheating. And they're like, okay. Because one of the things is very, very painful to the Chinese. Very, very painful to the Chinese. And so America kind of likes that. And then strategically, Japan's an ally. And I think the deal is the 1 times GDP, the gross overseas assets, which are parked in treasuries, they're going to be parked in a new sovereign wealth fund. And it's like Japan and America together. And Japan's private sector is going to get equity, dollar equity, rather than dollar fixed interest. So the whole, we're going to 200 on dollar yen. If we go to 200, I think there would be so just now, dollar yen 300, probability 15%. If dollar yen hits 200, probability it goes to 300, 50%. Does that make sense? No. So actually, what a friggin' year. Buy Japanese stocks, buy the frigging index. Like, don't be a frigging idiot, right? Buy the fucking index. Hedge the yen, and be very long silver and all the smaller, dense, precious metal assets. Probably wait another year until the whole halving language and cycle comes back for Bitcoin, and then swap a lot of the swap silver at 200 into Bitcoin at 120.
So you still believe in the 4-year cycle in the case of Bitcoin?
I don't believe in anything. I believe in me. I certainly, I don't think you're listening. I do not believe. I believe in longevity. I believe in a clusterfuck of observations. Do you know how many daily price observations there are in 40 years? Let me cut short. A lot, right? Do you know how many daily observations there are in 4 years? Fuck nothing, right? So I don't believe in any. I don't believe in. If I believe in I don't believe in cycles, but I believe in when asset price regimes shift, when the atom escapes the ceiling which has been there for 10, 15, 20, 25. When it breaks, the universe is changing. But to your point, there is a 4-year halving, which I think makes Bitcoin the king of all precious, the king of all scarce. Bitcoin, let's use Bitcoin as um, a coverall for everything crypto. We don't even have to do that. Um, Bitcoin is the only asset which, it's been programmed to be scarce. So it's a scarce asset like gold and silver et al., which is actually pre-programmed to become scarcer as prices rise. Right? As we sit here today, there are men in very, very expensive trucks with lots of explosives, with acid. They're leaching the soil, and they are endeavoring to get as much fucking gold out of the ground and into the market, And in Bitcoin, it's the opposite. And that is friggin' amazing. Amazing. And so it is prominent. Um, and it happens every 4. That's not a cycle. That's software. That's the iOS upgrade, And so we had one 2 years ago or something, and there's another one coming. And it would seem that for reasons that I certainly don't understand, there are the vagaries of something or other strange, but the halving's only 2 years away. Bitcoin only has a valuation of about $1.5 trillion, and it's going to be worth the same market value as gold, I would contend. And the whole thing about technology Bitcoin's going to be, the code's going to be cracked by quantum computing. I mean, there are risks to everything, but the genius really and the safest part of the Bitcoin is when it's held in your digital wallet. And the safest part is that idiosyncratic password that the dumb human creates, and you write it down somewhere, you get a tattoo or something so you don't forget it. Um, that that's that you can't crack that. Quantum computing does not have an answer for that. Someone told me, I know be, your crowd will get this immediately, but I, I was at Nikkei Beach on Sunday, and I was talking to a great guy, and he said to me that there are 2 passwords that control the internet in North America. I think North America, maybe worldwide, but they're stored and secured in North America. And if you can find those passwords, you can bring chaos. You can bring the world down. And the U.S. government goes to extraordinary, it's like a Mission Impossible movie, the protection of those 2 passwords. Passwords a password of that nature can't be taken out by quantum computing.
I was curious to also get your take on Trump and the Trump policies, because we've also extensively talked about this last time, and that you've loved Trump 2.0. Is it still the case? What do you think of all the recent events related to Venezuela and the ongoing, obviously, like Greenland's nothing new, but it's a resurgence of interest now that, creates a lot of chaos, one could say, in the geopolitical theater.
Yeah. I still love it. I mean, there's an oscillation in the marketplace, which is, this is too good to be true. So it's like, this is too good to be true. He's a liar, pants on fire. It's too good to be true. He's a liar, pants on fire. It's too good to be true is like an Ayn Rand, it's like Atlas Shrugged. I mean, Trump and his team is like John Galt on the radio going, "Oh, we are taking all you woke monsters down, all your liberal, you're gone. Business guys are back. We're taking the keys. We're mining for oil in Wyoming. We're opening the rail tracks again." It is a joy. It's the pages of Ayn Rand actually happening. We had again 50 years. Iran. I don't want to dive into politics, but I've always viewed the Iranian hostage situation was the big pivot moment in history. It was the triumph of the failure of the wokish international citizen, where Iran did the unthinkable and it betrayed the sovereignty of the U.S. embassy in Tehran and took hostages. And it was kind of like, they were ready to go. Oh, oops, sorry. Oh, really sorry. We got a little bit overexcited. We're very sorry. Take the hostages. We will leave. Okay. But instead, America didn't demand anything. It asked, please, like, we want to be your friends. And then that pathetic, not pathetic, that tragic helicopter intervention, which failed in January 1980 to release the hostages. And of course, that all coincided with gold being at its last high, gold and silver being at the last high. So it seems like the same cycle. So the alternative vision, and if it'd been Trump, and so the cycle we've moved into is the Iranians. So let's say the Iranians do it again. Embassy hostages. Okay. So Trump would be like, well, I am going to count to 5. Maybe 3. Okay. You know that with my Israeli friends, you guys I'm looking at you. I can actually see you. Let me describe what you're wearing. Okay. You will be fucking dead in 20 seconds. Okay. I'm not going to ask. I'm just going to turn away. Okay. Okay. I'm back. As we resolve the situation, right? That did not happen. But that is the world today. That is the world where the America is in the ascendancy. John Galt is no longer working as a laborer, but he's designing blueprints to engage the productive soul of humanity and without apology. It's so damn exciting. I mean, again, like I think we're at 2.6 or something GDP forecast for this year. Could be 5. It's not going to be flat or recession. And again, that's one of the things where the bond market's like, oh, he's maybe too good. He's maybe too good, But again, to that point, to the bond market, I mean, I saw Ray Dalio on Instagram as I was brushing my teeth this morning. It's the end of the world. So new price, like very bearish new pricing regime. Yeah, the Treasury's busted and the dollar's pathetic. Same old, yeah. Trump and what he's done to the Treasury market gets me very excited. I mean, you've got a nation state. So you have taxation and you tax your citizens and you tax the sovereignty, the landmass. You tax and anything coming in and out. They're taxing the world. Huh? As you can't. It'll be a disaster for the economy. Shut up. It's not been a disaster. We're doing good things, smart things that tenured economic professors dislike. Good. I would fire them all. Bloody Jeffrey Sachs and the guy with Weinstein, not Weinstein. What's it called? The the young guy, the bad guy, whatever. They're all loonies, and they've kept us. And the wokeism, they celebrated China. So Trump is a recurring bid for the market, and also the circus which follows him is paradoxically good because it keeps you on edge. They say bull markets climb walls of worry. Trump is a wall of worry. He's a fucking constant. He's a mass manufacturer of worry, and that's paradoxically good in managing. It stops the thing just like going vertigo. It's like we get pullbacks. We're in maybe a pullback just now with Greenland. And again, so today is, I don't know, whatever today is, 15th of January, we're recording this.
20.
Yeah, timeless, I don't even know the date. Have you seen Macron is at Davos and he's giving his speech in English, heavy French accent. Oh, but he's wearing, I know I want to speak, but he's wearing sunglasses. And he's sounding like a gangster. It's this Trump guy. He's crazy. He's not fair. He's the new boss, Tony Montana. But he's wearing these crazy sunglasses. So I detour anyway. So and then with stocks. So if we just examine the technology aspect, the tech stock thing, I think there's an actionable timeline in terms of expecting how long the price trend continues to be so positive. And there's a timeline which would suggest danger. And the timeline is that stocks will run further to bring in the cashing out of the private equity. Private equity's got to come in and make and establish a new market, a public market, which is better for their business. So they'll gain liquidity, and they'll be looking for they'll be hoping the public market again continues the daisy chain and goes higher. So, and it looks like in the summer that's going to start with the SpaceX, and I mean that could be $1 trillion capitalization, and it looks like you've heard the same stories that the ChatGPT or Claude, Anthropogic, whatever it's called, they're looking to get a foothold in private markets, and if they come through, you will have 50 or so other deals. And I'd say to you that that market will peak within a year of those IPOs. Like, so again, there's a lot of private equity stock to be sold, and they've got friends in Wall Street. And what do? They sell stocks. It will cost you, but the private equity guys have got cigars and like, you're sell, make me a market. It's going to be a market. This thing continues, and then it'll continue for another 6 to 12 months after that. But thereafter, I'd have a big amber sign. But that would be on the tech cycle. That'd be specifically on NASDAQ. That would not be with regard to Trump. And then the other thing I should flag, I'm going to jump again into one of my other screens, but we talked about Japan. We talked about JGBs. We should actually talk about the 10-year Chinese yield, because I think that will make investing in Chinese equities very simple. I am, without looking at this, I don't think my signal has come through yet, and again, I guess we'll be looking at it as I speak. Chinese equities had a great year. They outperformed US equities, probably up about, I'm guessing 30%. I'm referencing the FXI, the ETF, North American ETF. That's state intervention. State, it's a form of QE. The private sector has become profoundly intolerant of risk. Private sector would rather, it was preferring to own 10-year, and the 10-year yield on the renminbi was at one point was in danger of crossing below the Japanese before the Japanese started moving. I can give you a history story again. I liken it to the late 30s, early 1940s, when China was on a silver standard, not a gold standard, specifically a silver standard. And so again, silver was collateral. And we talked about the importance of collateral in the modern world. in terms of money printing via the euro-dollar system. And collateral today the purest form of collateral would be an overnight or a 7-day Treasury cash bill, Treasury cash bills, purest form of safest collateral. But collateral extends itself to a hedge fund equity portfolio of S&P 500 companies. Yeah, I could have $1 billion equity book, and I could go to my prime broker, and they would give me cash credit. And so what I was saying earlier is the dollar weakness is a function of when equities are going up, the counterparty is like, yeah, like, no haircut. And so they're printing more and more dollars, and that's why the dollar weakens. And it's the opposite when the mood shifts. But back to China in, let's say, 1936, the bank would make commercial loans on the basis of the amount of silver it held in its vaults. And that was determined, that quantum of silver would be determined by the trade balance of China with its partners. So trade surpluses would see an influx of high-powered silver money and the creation of loans and economic expansion. And then the poor Chinese were buggered by the United States when there was legislation was passed to assist and bail out the domestic silver mining industry in America. And the US government sought to do a kind of yield curve control. They were buyers of silver. They wanted a higher silver price because, again, where silver differs from Bitcoin, when the silver price goes up, the buggers, they mine more. Okay, so the American administration bid the price of silver higher, and regardless of trade, China started losing high-powered money. Silver was getting sucked out of its banks. And when that happens, you've got too much length in your loans versus your remaining collateral. And so you've got to call in loans. And as you call in loans, businesses fail. And you get emergency asset sales and prices fall. And eventually, China created a new currency and they created hyperinflation. Okay. Today, since 2008, maybe 2005, since 2005, for the last 20 years, 21 years, China has been on a property standard. The property value was the collateral of the banking system. It wasn't silver. It wasn't US treasuries. It was Chinese property values. And they're imploding. And that's caused banks to be very cautious extending credit. And in fact, at the margin, having to call in loans. You know, we just got a print this week. I think, 4.4, the lowest 5-year GDP print in China. Is really, in terms of without destroying economic value, China's not growing. You know, it's only growing because it's debt. The government's spending more debt. Anyway, but China's looking at the banking system, and it's very similar to silver. They've just had a huge impairment on collateral, and they need new collateral. And so the new collateral is they want to shift the market into a higher equity, like they want stocks. If they get their stock market is, I think I should know this better, but I'm going to guess it's 35-40% of GDP market value. Forgive me if that's wrong. We will correct this and we'll put the right figure. It's there now. Look, that is the right figure on the screen. How do I know these things? You know, it's over 200% in the US. China today is trading, I think, still below 2008. American large caps are trading 4 times higher. So the whole gig is let's cheat. and let's force everyone to buy equities, scarcity. And what, again, one of my wisdoms, again, I am not your stockbroker, but I can tell you things that I've learned over 30 years. You want to position yourself in an asset price that the government favors. And the Chinese government is now like, our number one favorite asset is the stock market. So maybe you want to buy Chinese equity. And the only caveat is where the 10-year Chinese bond is. So they had these big policy shocks at the beginning of last year telling you, oh, yo, buy equities, like, we're banning short sales, all that stuff. And so the bond market wouldn't like that. It would be the opposite side, would be the opposite side, and yields would surge. I mean, so we're now looking at the chart, and what we can see is that at the end of 2024, the 10-year Chinese yield got down to 1.6%, and that was kind of Japanese levels. And then last year, towards the end of the first quarter, going into the second quarter, we started to get these policy announcements. And those policy announcements are kind of scorched earth for the bonds. And really what the Chinese authorities want, they want people selling. They don't want people in fixed income. They want them selling fixed income and switching into higher risk. So going further out on the risk frontier, put treasuries are here, equities are over here, and they're trying to get them into the equity world. And so you come out with provocative terms, which are like news bombs, and you're basically trying to destroy the market's appetite for government bonds and rekindle appetite for equities. And so the 10-year Chinese goes from 160 and it peaks a whisker below 2% over the course of like a month. So it's a very violent, very short-term reaction. But then, the Chinese businessman, the investor, he looks around and he's like, I've heard all this stuff before. It's bullshit, right? And I still can't sell my property. And I still don't like my banks. I'm going to 2% on the 10-year. I'm a buyer of the 2. And so I'm a buyer of the 2% yield. And so over the course of the next month, 2 months, we came all the way back to almost 160. And then we've oscillated. Unfortunately, we didn't get back to 2. We then peaked at about 185. We peaked twice at 185. Anyway, I am boring you to death, but what I'm trying to tell you is buy Chinese equities when if the 10-year Chinese yield consistently trades above 2, Chinese equities are going to the moon. But again, hedge your currency. Don't do any stock research. Buy the largest company ETF and buy it with a dollar handle and not a renminbi handle. So I'm not saying do that now. 10 years about 180. But if it goes through 2%, will it? I don't know. I don't care. I just know what to do when shit happens. So again, we've spoken for a long time, and I began thinking I had nothing to say.
Like, when do you know until how long you ride this? So let's say it does cross the 2% and you're in for a ride. Do you then just constantly watch what the policymakers in Beijing are doing, or when do you know that the regime then shifts again, or the political priorities, to say, shift? It's not something that you can necessarily time.
So my shifts are long. I'm looking for long-term breaks. We've been talking 50-year cycles and stuff. The Chinese equity market has done nothing in 30 years. Long. The resolve for the government is for it to go up. If it can achieve it, it's got a long way to go up. So this is not a 1-year trade. This is like, if this if it works, this is like, again, you make 4 or 5 times your money. Okay. But I don't know if it's going to work. I think I said an almighty task to get Chinese equities going up. Almighty, because of the sheer, again, quantums, mass, weight. No one ever talks about it. They feature very prominently in my mind. Like, China's property market was valued at $60 trillion. GDP is like 18. That's just, this doesn't happen. The M2, there, which is Chinese renminbi, the dollar translation of that is $45 trillion. That means that the renminbi is worthless, right? There's no way you could, there's no bid for 45 trillion. Hey, can I buy dollars? How much renminbi? I'm selling 45 trillion. I'm selling everything. What's your bid? Go fuck off, right? Or 100 is certainly not 7.5. So China's going to have a profound inflation, and that inflation may well take the form of currency weakening and stocks ballooning higher. We're in that kind of barrow environment. And the great thing is we've got guardrails. We've got the 10-year Treasury in China going to tell us. I promise you. I don't think Chinese equities, I don't think they can repeat last year without the 10-year consistently exceeding 2%. So write that down. And if we're speaking this time next year, call me out on that.
Noted. And they've also been aggressively QE-ing as well in the last year as well. So that's also probably like oil on the fire.
Yeah, I mean that's all part of what we're talking about.
Yeah.
So what you're doing with QE is you're coming in and you are trying to piss on the carpet. Private sector's like, man, fucking property. I'm like, but I've still got some money. Got to look after myself. I'm going to buy Chinese bonds, and I'm going to keep buying Chinese bonds. And the government comes in and is like, no, stinky PP time. What it wants to do is it wants to price the bond where there's no expected return. There's no expected return if there's 1% return at a 1% yield. But when the property market was turning, you were getting 4 on Chinese 10-year. That 4 then became 1, and the QE took it to 1. And then they're like, we've got to make big announcements. We just got to tell people we've got a hard on for Chinese equities. So yeah, it's the two forces together.
And on top of that, so yeah, you haven't though mentioned, I think, gold and silver also in the context of China. There's been also incredible demand that's driven the price of gold eastwards, and giant premiums also in silver.
Yeah. So I mean that's just garbage. It's utter fucking garbage, right? I don't know if anyone told you, but China has a closed capital account. Okay. China can have $45 trillion equivalent of renminbi in its banks because you can't sell them. You can't buy dollars. And do you know what? If you can't buy dollars, you can't fucking buy silver and gold, right? And do you know what? The fucking Chinese government won't let you do it. So there's a float of gold in the system, in the Chinese system. Yeah, it trades at a fucking huge premium because the money's all trapped there, right? In America, gold at its present valuation is 5% of M2. The American sovereign's stake, the amount of gold it owns, is 5% of the value of the market, of the size of the M2 of money. Yeah, you understand that? Should I say it slower? M2 is $18 trillion. GDP is $30 trillion, 27, 28, whatever. If you take the Fort Knox, etc., and please, if you're one of those loonies, you said they don't have it, fuck off again. I got no time for you. If you take the official gold holdings of the US government and you take the market price of gold and you divide it by $18 trillion, that's 5%. So, if you will, US money supply is actually gold backed. 1/20th of US dollar money supply is actually physical gold. Okay. In China, it is basis points, it's hundreds of 1%.
Yeah, if you take official reserves.
Again, if you're going to start being an amateur and tell me that there's these things that they hide and stuff like that, have that conversation with someone else. Okay. I'm a successful investor because I don't do that bullshit. Okay. It's absolute bullshit. But it's great if I'm a broker and I'm selling shit and I tell people I'm the Wolf of Wall Street, hey, you better buy it because like the unofficial figure, how do you know the unofficial? Oh, we've got this special guy in Beijing. Bullshit. Okay. Bullshit. Okay. And so the Chinese, they could just buy gold. You know, the big, that would solve the problem. Then their currency would not be confetti. It would have a gold backing. The amount of fucking gold they would have to buy, how would they buy gold? They would sell renminbi and they would buy dollars and buy gold, right? And if they got to 5% of M2, Chinese M2, right? The selling pressure would have pushed the renminbi to 8. And then people like me would have pushed it to 9. And then there'd be a big disaster. You should not. You are. But you shouldn't. Sometimes it doesn't matter. Again, like I say, in all times, life and success is about being lucky and staying lucky. Be lucky bullish and use stupid theories, if you will. Sometimes they do push you into bull markets. That's fine. There's a bull market in gold. There's a bull market in silver. It has blinking well nothing to do with the notion that the Chinese sovereign or its citizens are going to be selling confetti for dollars and buying, what's 5% of 45 trillion? Buying like buying 2 trillion dollars of gold. You know, there's a thing called physics, and everything has implications. But closed capital count means it means the citizens can't do it, means the banks can't do it, means the safe and the central bank can kind of fuck around at the margin. But again, they're in a straitjacket of a fixed exchange rate regime. And so there's only so much they can do with that. So gold is going up. I would not. If you're in gold, well done. Beyond 6, but would gold be my biggest holding today? No. I'd have more silver than gold. And I would have a portfolio of the other smaller, the palladiums, the platinums. I would have Bitcoin. I'd be looking to have a lot more Bitcoin. I dream, like I said to you, I dream of being able to swap 6,000 gold or 200 silver for Bitcoin at 100 or 60. I would have Japanese equities. I'd be long the dollar, short the yen. If I was a $1 billion family office, I would allocate about 10 basis points of my wealth to 10-year peg blow-ups in the Saudi and in Hong Kong. And I would own a lot of Chinese equities if the 10-year trades above 2%. That is the world of asset capitalism.
You made earlier, like the last time we talked, you also talked about SOFRs, expecting political pressure to crush the real yields. And how is that position? Betting on yields going down.
Again, I'm the joker, the provocateur. I am not the smart person. I don't seek to be the smartest person in the room. I seek to be the weirdest person in the room, because weird people make money in an idiosyncratic manner in a timeline which is unique to them and is highly valued by the market. So when the smartest people in the room, when they blow up and cash yields are at zero nominal in the States, they're like, but that's so fucking crazy. Who could have thought that would happen? And that's where I come in. I'm like, me. And you go back to this conversation. There is a mechanic. There is a piece of plumbing in the US financial system which reflects powerfully flexive and convex. Convex just means it's like gears that it can really, 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 really move, bigger or smaller. And I gave some mention to it earlier when I said no one is transacting, no one's buying or selling houses because everyone's locked into a 3% mortgage payment. And you'd have to double your mortgage payments if you move house. So no one's doing that, right? So we know something which is unique in the history of America. There has never been an 12-month period of such intense mortgage refinancing where literally everyone refinanced at the same rate, at the same very low rate. The mortgage-backed security market, that's a bond. It's a very safe bond. It's like a government bond. It's highly coveted by financial institutions. Even the Chinese, they buy mortgage-backed securities. Money center banks invest in them. So money center banks, they extend you a loan, and then they want to hold that loan as an asset, or they might sell it on with their brokerage. Okay. But embedded in the mortgage asset is this option where the entire community can refinance. So you've got this duration risk. You never quite understand the maturity of the asset. Now, when everyone refinanced, the bank balance sheet of Citigroup, JP Morgan, it went, like their heads went around 100 times. Their hedging was completely wrong. And what they had to do was they owned too much 10-year Treasury, and they had to bring down the duration. So their asset book duration collapsed. Their liability book's up here. So they had to collapse the liability book. And that meant they had to sell 10-year at the same time as inflation takes off and we get to 9%. So even regardless of the inflation, Citigroup had to sell yards and yards and yards of 10-year to bring duration on its liability book into sync. This, again, is why 10-year, 20-year, 30-year treasuries on their own are interest. They've had a 50% drawdown. That's almost 3 standard deviations from that. Shit never fucking happens. Never happens, right? But we had this amazing development in the refi market, which completely knocked out the banks. And we got the yield curve that we've discussed, and we got the yields being higher, and we didn't get the inflation. However, anything that goes up can go down. And there was a situation in 2024 where, like, global bond yields, we discussed China, didn't we? We said at the end of 2024, the Chinese 10-year was 1%. China's an emerging market, had 1% 10-year. The 10-year bond was 2%. Swissy cash went negative. And the Treasury 10-year started slipping. It got down to about 3.4. I think it got to 3.4. And so you're starting to get to a point where you got to realize, if the Treasury goes below 3, heading to 2.5, people will start refinancing again. And they'll start taking out new mortgages. Now, what happens is, so the bank, Citigroup's sitting here, this is my duration, I'm flat. But the 10-year yield comes down, housing market takes off, mortgage ownership, mortgage growth. So your asset, your duration is going to go up. Your liability has to go up. The only way you get your liability to go up is you have to come in and buy 10-year reflexively. So there's a arcane part of the hedging of, like, the total balance sheet of Citigroup is, I think, $2.3 trillion. Big numbers can produce very, very, very small numbers. Can produce, like, you could get back to the lows we saw in COVID. I'm not saying you will, but I'm saying to you, you better fucking understand that there is a little wrinkle in the universe. There's a little bad code where that shit happens. I'm here to tell you about it.
Great. So just to resume this, Hugh, you believe more in convexity than, also some form of diversification, I guess, but convexity is for you like the prime factor here in terms of the way you choose your assets at the moment.
So two things. Again, if it's a hobby, even if it's not a hobby, you kind of want to think of the architecture of your portfolio. Like, we're on this call and there's 2 quadrants. There's you, there's me. Let's say there were 4 people on the call. There would be 4 quadrants, right? There would be the S&P, NASDAQ. There would be 10-year securities plus duration. There would be alternative assets, Bitcoin, gold, private equity, private property, etc. And there would be cash. So I'm always thinking, where's my book? I want to be represented. Diversification. Back to, I was like being rude to one of the greatest money makers of all time, the Ray Dalio. That was his foundation stone. Permanent portfolio, always having representation. And actually he took discretion away. He rebalanced, I don't know, monthly, quarterly, so that each quadrant had the same volatility. So as volatility shifted, it made him take either cyclical or anti-cyclical changes to his asset allocation. And 50 years later, he was one of the richest fucking investors in the world. Smart. So worked for Ray. Why are you not using it? Okay. So where I am, blue sky for equities, I've got to have some, probably NASDAQ. Yeah. Oh, and Japanese equities. NASDAQ, Japanese equities. And if China breaks the 2% yield, I'm in Chinese equities. Easy, right? Treasuries, damn. Really want to have a treasury holding, but it's doing nothing. Doing nothing. I don't want to be, maybe it's silver. Maybe it's silver in 1980, right? 1987. Silver got down to, I don't know, like probably $4. But silver traded at 10, for like 10, 20 years. That's what happens if you invest in something without a trend. I'm looking at my treasury. I'm like, toyed and wasted money in the past trying to buy calls. And probably less if I was actively managing. It's not great vol, but you would own like a 2-year TLT, 2 or 3 year out, and you would sell weekly expiring to try and make it free. But I just can't say they're committed to an asset class which isn't trending. Okay, so let's add a third word. So you had diversification, the 4 quadrants. I haven't mentioned convexity, but I've introduced direction, trend. Trend has to verify where I am. Japanese equities trending, Nasdaq trending. Chinese equities have been trending for 18 months. So tick, 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 tick. Bonds, nothing. So that quadrant, I don't know, really like just now. We'll move on. I'm big in, well, personally, I own St. Bart's real estate, but that would be, I'd have gold, I'd have silver, the PGMs. I would have Bitcoin, but I'd be looking to try and trade that quadrant with time. I try to be running gold to 6,000, silver to 200. And when that's done, I would then be very, very greedy with Bitcoin. I still maintain it will trade $1 million. And then the final quadrant is maybe where I solve for the 10-year. I would have cash, dollar cash. I'd have dollars. I would have my peg blow up. I'd have my one touches on the currency. I would be short yen, and I'd be short renminbi. So that's diversification, that's trend. And then where I am, the best return comes with convexity, but the probability is so low. So it can't be all of your portfolio. Yeah. If it is all of your portfolio, I was in St. Bart's. I had dinner with a young, very attractive girl. She does hedge fund sales. I was like, oh, so tell me about what is the fund's biggest drawdown, calendar year drawdown? And she said 80%. I'm like, get out of here. How the hell do you afford to get to St. Bart's? That's why I'm buying, Why? Tail fund. Don't invest. I was a tail fund. World blew up. I made a lot of money. World didn't blow up. I did not lose 80%. I lost a little bit, 8%. So I compounded. So all you morons are going to look at Wikipedia and you're going to say, oh, he was a failed hedge fund man. Fuck you. I was not a fucking failed anything. I'm hot. I did 8% per annum for 15 years in an idiosyncratic thing that didn't correlate to anything. When the world kind of touched the guardrails of hell, I was your man. I bailed you out. That was my thing. So, to the boys. So you get that 80% drawdown if everything is convex, right? So it's again coming back to this word diversification. You want some convexity. You can't have everything convex.
Well, thank you, Hugh. I think we can wrap it up. Apart if you have some other thoughts or things you want to conclude on.
I'm done. I was done an hour ago.
All right, we're closing the veil. Thanks, Hugh. Thanks for your time. I appreciate it.
Thank you for waking me from my slumber. Who knew I still had thoughts in my head?
Well,
thank you very much, Alex.